just go home tonight and somebody, your spouse, your friend asks you, hey, yeah, you're taking finance management, yeah? What is finance? He or she is asking you, what is finance? What would be your possible answer? Nothing? No, you cannot be silent.
Getting money, investing money.
Yeah, so managing money is finance. Finance is about managing money, folks. That's simple. How you manage money. That's it. So is it important? Is money important to you? Yes, of course. So in world of finance, folks, we do have financial markets, financial institutions, and we would like to identify some of those. And also I'm going to tell you what are the major decisions in finance. But first of all, we have financial markets. Can anybody tell me who are these? What are the examples of financial market? When somebody say, hey, this is a financial market, what is meant by that?
It's a market where you can either secure funding or trade securities. Like
Excellent.
bonds.
So you basically buying and selling what? Financial assets.
Yeah.
In real market, folks, what do we do? We buy and sell goods and services. You buy your laptop, you buy your automobile, you buy insurance. That's real assets that you are exchanging your money with. In financial market, instead of real asset, you buy and sell what? Financial assets. So what are the financial assets? Can anybody give me some examples of financial assets? Stocks. What else?
Securities?
Property. Property is real asset. Financial assets.
Like how you trade on some company.
Yeah, bonds, stocks, right? Derivatives, those are all financial assets. Let me ask you one more question. Financial assets also being issued by the federal government. So what we call those Treasury Securities. For instance, when you buy Treasury bond, you're buying what? Bond from the government. Or basically you're loaning your money to government and holding of a piece of paper that we call it bond. We're going to spend a good time on valuation of bond in future discussions. But bond is a piece of paper, right? We call it financial assets. Federal government also issues treasury bills. The difference between bond and bill is that bond is for long-term investment, bill is for short-term. When you buy treasury bill, it's within a year, meaning that you could buy and sell it anytime you want within a year. However, treasury bond normally is 1 year and beyond, up to 40 years. So you could buy a bond that's 5 years, 10 years, 15 years, or whatnot. And that's the only difference. Now, Treasury Department or security that is issued by the Federal Reserve, after Treasury bond, Treasury bill, we also have what? Treasury note. Everybody's with me? Treasury note. So what is Treasury note? I'm going to ask you this. I told you what Treasury bond is, what Treasury bill is. What is Treasury note? And there is a reason why I'm asking you, because you should know. Have you ever read the money that you hold in your pocket every day? Read it. Read it. What does it say? This is a what? Federal Reserve note. It's a note. IOU note. For some of you who studied economics, you should know that basically our money, paper bill, is IOU note. What is the note, IOU note that Federal Reserve gives us in exchange of what? Historically, exchange of gold. Basically, they hold our gold and put it in our gold reserve, their gold reserve, and issue a piece of paper to us that they call it note, and we call it money. Everybody should be on that? So, those are all about securities. Now, we were talking about the financial market. If a market is a place that you exchange your money with financial assets, it's called financial market. So what type of market we have out there? We have a bunch of them. They do different things. Example of financial market is stock markets, right? Everybody knows that. What else? Bond market, yeah. What else? Money market, exactly. Also you have what? Capital market. So what is money market and money market accounts? What is it, Steve?
This is an account where you can invest.
Investing on what? Short-term investments like CDs. That's money market. Capital market is for long-term investments. Your stock, when you buy stock, is in capital market. You buy bond, is in capital market. So, money market, capital market, stock market, bond market, future market, and those are all different financial markets. The biggest of them all is, let me see if you know that, the biggest market that changed the most amount of the money or changes hand in the daily basis is
New York Stock Exchange?
no,
No.
foreign exchange market. Foreign exchange market. You know how much the daily basis changes the hand or in the market in daily basis? $4 trillion. With T, folks. Trillion has a lot of zeros. $4 trillion is changing hand in foreign exchange market. Now, of course, you could expect that because all countries are involved in it. It's not only about one country. Okay. So, if those are the financial markets where borrower meets the lender in how this operates, basically there are a group of the people out there that they have extra money and they want to make more money. And there are a lot of people out there like me that are in need of money that they want to what? Invest or spend. So when we meet, lender meets the borrower, creates the what? Financial market. In a general definition of it, as you said, by the way. Now, if that's the case, then what would be examples of financial institutions? Financial institutions.
Bank.
Banks, commercial banks, right? What else?
Federal Reserve?
Central banks.
Federal Reserve?
No, that's not part of the financial institution. Financial institutions are private. Federal Reserve is not a private entity. Federal Reserve, we're going to talk about it, well, briefly maybe, in the future discussions. Federal Reserve basically is an entity that is totally independent of all private or the government. You follow what I'm saying? They are not part of private market. They are not part of the government either. They are independent entity. Okay, what does that mean? It means, how do you look at the Supreme Court of the United States? Are they government agencies? No. Are they private industry? No. They're just independent institution, independent entity. Now, do they have influence by private and the government? Yes, they do. This is how it happens. Of course, as you know, if somebody wants to be part of the Supreme Court as a judge, that individual is not hired or fired. That individual normally is what? Nominated by the president, and the House has to approve it, and that individual becomes a Supreme Court judge. However, the moment they become the Supreme Court judge, nobody can fire them. Even the President of the United States cannot fire him. You could impeach him the way that we could impeach our president, but that they have that status, if you will. Folks, Federal Reserve is no different from it. The moment the chairperson of the Board of Governors of the Federal Reserve is appointed and approved by the Congress, guess what? They're there for a long term, and nobody can fire him, nobody can influence him, nobody could tell him what to do or what not to do. It's like Supreme Court judges. Even the president cannot tell Supreme Court judges that, hey, I want you to make this decision. It's irrelevant. So exactly the same thing. So we're going to talk about this briefly in the future. That's why we don't look at the Federal Reserve as part of our financial institutions. Although they are central bank of the United States, meaning the Federal Reserve is the bank of all the banks. Follow? They are the banker of all the banks. What else we have as far as the financial institutions? Okay, so anybody, anything else that comes to your mind as part of the financial institution? We said commercial banks. We said also, I'm saying it, investment banks, right? What is investment banks? What would be the example of it in our world, in our economy?
AIG.
Yes, exactly. Merrill Lynch. And many of the major banks, all the 7 major banks that we have in our country, they also do have investment services, meaning that they are commercial banks plus investment banks. Like Bank of America, Wells Fargo, Citibank, Chase, those are all commercial and investment banks. They are big and they provide all these
So would
services.
Goldman Sachs be just an investment bank?
What's that?
Would Goldman Sachs be just an investment bank?
Would Goldman Sachs be just an investment bank?
Yeah. They're on. So yeah, Goldman Sachs or Merrill Lynch, you're not going to go there and say, hey, please deposit this money in my checking account. You see what I'm saying? They don't deal with you guys.
Right.
They deal only with the investors. Yeah, Goldman Sachs is another one that is major in our financial market.
Are we going to touch on the gold standard at all?
No. Actually, you should answer that. Ask the question again.
What?
Ask it again?
Ask him.
I said, are we going to touch on the gold standard?
Oh, touch on it. I thought you said we are involved.
Sorry, it's like a fraud. I know.
No, I'm no.
For this, yeah.
Yeah, so, yeah, I will, but when we get to talk about the financial crisis and role of the Federal Reserve, money supply, and what is the concept of money, I'm going to talk about those, but toward the end of the class. But unless you want me to talk about it now, I have no problem with that. But as you know, that gold standard no longer in effect. I mean, this is historical system, historical event. But it was extremely important to establish the monetary system of the world, because bottom line is, what is money, right? I mean, definition of the money. What is money? Money to me is like a piece of paper that has picture of dead president on it. Really, it's a paper. But why we trust it goes back to our gold standard. Meaning that there were times that we said, okay, we're going to issue this IOU notes, because after all, they are notes, right? We're going to issue IOU notes and give to people to do their business and the economic transactions. But then on behalf of this piece of paper, we're going to get their gold. And nobody can issue or print money before putting the what? Gold reserve on behalf of this particular financial asset. Because all the financial assets must have real assets backing it up. However, we also have financial assets that they don't have any backing. And those are extremely risky propositions. What are those?
Bitcoin?
Yeah, here we go. What kind of financial asset back in the Bitcoin or cryptocurrencies? None. So it could go upside down any day. The same with junk bond. What is junk bond? Well, a bond that has no asset backing it up as a collateral. Mean that anybody could issue bond. Really. As long as you get the permission from SEC, Security Exchange Commission, you could issue bond. I can go out and make an application and they might give me permission to do it. But if that's the case, how come I'm not doing it? Because nobody's going to buy my bond. Hey, what is this bond? Dan is shoddy. What kind of collateral he has? He has nothing. Oh, okay. It's a junk bond. I'm not necessarily junk bond is always bad, but if I have a business, if I'm involved in certain economic activities, then yeah, junk bond people may buy it. To what? To balance their portfolio. But I'm not involved in anything. I'm a teacher. What kind of rate of return I'm going to give them? Nothing. Or even if I say I'm going to, I don't have the capability. So that's why people do not buy a bond of any particular institution or person just because they have the permission to issue bond. You have to trust those bonds. If municipal bond, if it's a treasury bond, is a corporate bond, because of that, just public doesn't know who is behind this bond. Therefore, bonds are what? Rated. Bonds are rated. Triple A, double A, triple B, double B. I'm sure that you know that. Especially you guys that have economic courses in investing. Then what is that purpose of rating? To inform the public that this bond is backed, let's say, by IBM, so therefore it's AAA. Or this bond is called junk bond because it was issued by Steve Wynn, who was trying to build Las Vegas. By the way, Las Vegas was built by junk bond, believe it or not. So what kind of risk we're taking? Big risk. Can we sell junk bond? Yes, we can. Many people buy junk bond. Why? Because they want to balance their portfolio. They have a lot of conservative stocks in there, a lot of conservative bonds in there, and they want to give some life or flair to their investment and balance it instead of being totally low risk, low return. They want to make it normal. If you have all junk bond in your portfolio, then you have what? High risk, high return. You don't want to do that either. So, we'll talk about this later, a little bit more about it. But please remind me when I'm talking about the financial crises on week, I think it's 10, to elaborate on gold standard as well. But I'll give you some ideas now. I already touched on it a little bit. Okay, so financial institutions. What other financial institutions we have? We identified a few of them. How about insurance companies? Are they financial institutions? Yes, they are. How about pension fund companies? They are, right? So they hold the pensions of the employees and they distribute the money or the payments after their retirement. Those are purely financial institutions. However, the most important financial institution that they play an important role after the banks are mutual fund companies. What is mutual fund company? You should know.
It's a company that collects money from investors and then invests it in aggregate.
Wonderful. That's exactly what it is. They take your money, they create a portfolio for you, and they buy stocks or other financial instruments to create a portfolio that basically provides you a rate of return every period, meaning that their intention is to make money for you. So obviously, when they are doing that, they of course they take your money. But here is what I said earlier. If you don't have any financial knowledge, you don't know how to analyze stocks, how to analyze bonds, and how to analyze your portfolio, how to mitigate the risk on your portfolio, how you assess the risk on your portfolio. If you do not know that, you're at mercy of their decisions, basically. And normally they don't care about you, let me be very honest with you. Unless you have like 10 or $50 million. In that case, they assign stock analysts and specialists to watch your portfolio every day. But those are expensive people. They don't do it for 200,000 portfolio. You follow? They do it for 50 million portfolio. That's why you must know finance to really monitor it yourself and even manage it yourself. There's really not much to it. So, mutual funds, yes, exactly, that's who they are. Also, we have what we call hedge fund companies. What is hedge fund company? They are like mutual fund, but they don't deal with anybody that has what, less than 1 million. So take him 900,000 business and go someplace else. So yeah, they deal with millionaires, basically, hedge fund companies. Why this is different than mutual funds is that hedge, what's the meaning of hedge?
Manage risk.
Mitigating the risk, getting rid of the risk. Exactly. Hedging, meaning that I'm minimizing or mitigating the risk. Hedge fund companies are committed to mitigate the risk in your investment. Okay, so mutual fund companies are not as much committed. No, they are, but there's a difference here. If you have $15 million and you take it to a hedge fund company, what is your number one priority and concern? Is not to make a lot of money, but rather what? Not to lose it. Exactly.
Capital preservation.
Exactly. So hedge fund companies, without, well, not legally, but socially, they guarantee that they are not going to lose a dime of yours. Of course, like I said, they are obligated, but you cannot take them to court if you lose money because there's not legal obligation. But you could bet your bottom dollar that they're going to watch your portfolio and you would not lose, period. Because also they are not regulated institutions. Mutual funds are regulated, but they are not. So they could do anything, really. That's why hedge fund companies are different. They are basically designed for very rich people, so to speak. Yes, sir.
I have a question about, so if they're primarily the same thing, a hedge fund and a mutual fund, why is the mutual fund regulated but not the hedge fund?
Good question. Because I think, again, just one perspective, not necessarily there's a written laws on it. The perspective is that for the people to manage big money, they need more freedom.
So where do they draw the line?
Again, these are more questions toward the Department of Justice that, hey, what are your laws and regulation, or actually SEC more than the Department of Justice. SEC basically its job is to create a criteria for them, say, okay, these are the areas that you could do few things, these are the areas that you cannot do few things. For hedge companies, it's open season. Now, where is it the line is drawn, it's all SEC decision. Meaning that there are areas, perhaps, again, my assumption, not that I have written that, my assumption is that hedge fund companies, if they are not violating the written laws, they're okay, basically. However, mutual fund companies cannot do that. They cannot invest in certain things and so forth, so on. And they have limitation on the amount of the investment, number of the investment, type of the portfolio, type of the financial asset, and so forth, so on. There's a lot of regulation involved with that. But answer your question very simply is that these are all decisions of SEC. And they have certain guidelines. So what are those specific guidelines? I don't know. I don't know.
Meaning SEC? So,
Security Exchange Commission. Yeah. Yeah. I call it SEC all the time, that's right. Okay, now, the last financial institutions are called private equity company. Does anybody know what those are? Private equity companies are the companies that they look for failing institutions or companies, and they go and take over that business, and the takeover normally is a hostile takeover. And then they chop up the company and sell their assets. That's their job. There was a movie a long time ago that Richard Gere was playing on it, and he was the owner of a private equity company, and he was doing that. But the idea here is basically they're like vultures. They look and smell certain companies that they are not performing well, especially their stock is not performing well, and they go and first they approach the, of course, CFO or CEO or say CFO or the president of the company, and they offer certain price for their stock, and they say that we are going to basically take in this company and sell the assets piece by piece. We're going to chop this company in different assets. Obviously here, normally, as you could imagine, the executives of the companies would not allow such company takeover, because after all, the owner is committed for their, owners are committed for their investment and so forth, so on. So they would not normally allow these companies take over. So what is the avenue, how they take over then? They go straight to their stockholders. They announce a meeting, let's say town hall meeting, all the stockholders of, let's say, ABC company, get together there because we're going to share some important information with you. So, of course, company cannot do anything about it. They are stockholders, they're out there. They cannot prevent them to go to a meeting. So when they hold these meetings, they try to convince the majority of the stockholders that if they sell the company to this private equity company, the price of their stock is going to jump, let's say, from $40 to $70. And that's how they convince the majority shareholders, and they take over. That's their business. Okay. Any questions so far about all these stuff? These are very simple, straightforward, introductory discussions. Nothing really earth-shattering here. Now, okay. Most of the things that you're going to see in these slides, I talked about it. But we're going to be focusing on certain areas that I haven't covered yet. There's a type of the organizations. Again, folks, remember what I said. I'm going to only cover the important items, the things that we need to analyze it more, understand it better. Some of the descriptive stuff in your textbook, I'm not going to spend the class time on it. Like, okay, what type of business organization we have? Jesus, yeah, well, right there. Partnership, corporation, proprietors, each one has certain advantages, disadvantages. What is corporation? What are the characteristics of corporation? What is the advantage and disadvantage of corporation? The only thing that I might add here is that in what type of corporation you don't pay double taxes, or double taxation is not applicable to those corporations. S corporations. S corporations are corporations that they don't pay double taxation. Other than that, all the corporations, specifically C corporations, pay double taxation. What is that? What do I mean by that?
They pay taxes on dividends as well as their earnings. They pay twice.
Correct. Not only they're going to pay their taxes on their dividend and their profit and so forth, so on, and capital gains, but also at the end of the year they're going to be filing what? The individual tax return. So combination of these is double taxation. If your corporate tax is 35% and you individually fall in the 35% bracket, guess what? You're paying like 70% of your income as taxation, and that is not something pleasant. I will. I think so. I'm not sure that's done, but I'm going to share with you some of the experience that my family members had on this one. That is so. For the first time, really, I was surprised by it, let alone him. Well, actually, I'm going to share it right now. That's fine. The impact of double taxation in certain occasions is so devastating that companies try with all means to form their companies in S format or partnership format rather than being C corporations. The example that and I experienced personally was when my brother-in-law sold his company. My brother-in-law is an entrepreneur, and he builds company basically and sells it. The first company he built, it was 1995, if I'm not mistaken, or somewhere around there. And then by 2005, he sold his company. Actually, that was his job, basically, built a company and sell it. He never stays with one company. So this company grew to be an international company. He had branches in India, Madras, in different parts of the United States, Austin, Texas, and San Jose, and all these stuff, Oregon. So he started this from ground zero, believe it or not. The only money he had at the time was investment of a couple of friends of him that basically wanted to invest with him. And also later on he went to venture capital companies and then got connected by some investors. Of course, venture capital companies, if we get the opportunity, I'll talk about it. But guess what, folks? We're going to have a lot of stuff. I don't know how many of them I'm going to be able to cover. So what happened was that he grew. He's a smart kid. By the way, his background is he got his chemical engineering from one of the universities in India. Not Madras, but there's a big, huh? Okay, yeah, probably that. He graduated from there. So that, he didn't have any financial background, actually. So at the time he was very young, I helped him out to come to the United States and get his citizenship and all this good stuff. So I played like a big brother for him, just because I'm older than he is. Now, Sony and Qualcomm competed to buy his company. And he was loving it because when there is only one company interested in you, normally the bargaining power is in the other side. But when several companies are interested in you, bargaining power is in your part. So played the game right. Finally, Qualcomm ended up buying it for $200 million. So when by the way, $200 million is not his. He has also a bunch of stockholders. So, but he was the majority stockholder. He got a good portion of that. So, and also he already gave me 10,000 of his share of his company also, but it ended up being diluted. And I was thinking that, oh my God, I'm set for life. Nah, no, it wasn't like that. I got a few bucks. I could take my family to McDonald's or so. But when he sold, my sister called me and said, oh, today's a good day. We sold the company always. So I called them. So congratulations, I'm very happy for you. I said, no. Tell me my condolences because I'm crying here. I said, why? You sold the company with $200 million to Qualcomm. Why are you crying? He said, I paid 75% of it as tax. 75%. So he says, there is no celebration here, buddy. That's how it is sometimes. Okay. Yeah. So we were talking about the type of corporations, type of organizations. By the way, I do have difficulty with certain verbiage that is in your textbook and also I see it in other literature. And they refer to for-profit institutions as organization. They are not just organizations. Because all the firms are organizations, but not all the organizations are what? Firms. We're talking about firms here, not organization. We're not talking about non-profit institution, the charity. We're not talking about that. We're talking about the firms, for-profit entities, organizations. So when they say this organization, no, it's not organization, it's firm, it's for-profit. And I've seen that in many places. Normally they don't pay attention that, yeah, all the firms are organizations, but not all the organizations are firm. So if you're talking about for-profit organization, refer to it as what? Firm. Okay, so one thing I'm going to cover this in detail next week is the idea of what are the functions of ratios in finance. Why we need to see everything in form of ratios in finance. And you're going to find out that there is only one ratio that is the most important, and the rest basically they don't mean as much. They don't matter as much. All the firms do have one goal, and that is to increase the value of their ROE. Anybody knows what ROE stands for? In your accounting, you probably should have had this discussion. I'm not sure.
Return on equity?
Return on equity. Thank you, Steve. Why return on equity is the number one priority? Is the most important ratio. Actually, the rest of the ratios become irrelevant if you achieve the enhancement or increase in the ROE. Because ROE is the only thing that matters, folks, for the firms. If I'm the CEO of a firm and I'm saying, well, our priority is to serve the market and do our jobs ethically, or somebody else says, some others feel, well, safety is these are all nonsense. They have only one task, one priority, numero uno, increase the wealth and what? Value of their shareholders. That's it. Meaning they try everything possible to increase the price of your stocks in the market. Now, whether you're private or publicly traded company, doesn't matter. Why this is important? Because think about the alternative. What's the alternative? My stocks are not increasing in value. Guess what's going to happen? Your investors are going to dump your stock and buy other stocks, and your stocks are going to drop in the value, price, and become penny stock. That's what's going to happen. And guess what, Mr. CEO? You're going to be out of business in a matter of no time. You better find a new job in McDonald's someplace. That's how important it is. None of those criteria that people, and mostly in media, that they put emphasis on it, they are irrelevant. Even if somebody said, yeah, our priority is to be profitable, that is not even enough. Because the return on equity is not just the profitability. It's a combination of three things: profitability, efficiency, and financial leverage. You've got to have all three of them to have return increase in the return on equity, ROE. So that's the ultimate goal. What's the goal of it? How you want to make a company successful? Well, they should be profitable. Yeah. They should have also. They should be efficient. Yeah. Also, they should have financial leverage. Yeah. Well, if you have all these three, you have what? Increase in your return on equity. Otherwise, you wouldn't. That's the point. If you lack even one part of those three pillars, you're not going to have increase in your ROE. And ROE is it. That's the holy grail in the market. So, therefore, because of that, we put emphasis on equity. Oh, shoot, what is equity? Every time, folks, I'm going to use some of these jargons, of some of these technical words. Throughout our course, I'm going to repeat it so many times that when you walk out of here at the end of the course, you're going to know what they are. You're not going to forget those. And if you don't use these in the world of finance, nobody's going to understand you. Follow? Okay. Equity. What is equity? I talked about what equity, private equity company, and here ROE, return on equity. Well, you also have other courses that talks about this, right? What is equity?
Ownership.
In finance. What?
Ownership,
Oh, what?
whatever you have equity in, firm,
Okay.
property.
You said it, but I'm going to say it a little bit better than you. Okay, folks. Equity meaning of this claim. Claim of what? Claim of asset. Okay. Actually, I'm repeating what you said, but you said it in a little different ways. So equity is claim on asset. Therefore, how you have claim on asset of IBM? When you buy the stocks, so that is your equity. Okay. Also, some people say, I have equity built in my house, right? You all heard that. What is that? What is that equity? Is it the same? It is. You know how, Josh? When you bought your house, let's say $500,000, where did you get this money? You borrowed it. So, you're not owner of your house. Bank is the owner of your house. You own your house when you what? Make all the payments. However, your house may gain in value throughout the years. Now, somebody is willing to buy your house $700,000. Oh my God, I only owe $500,000 to Bank of America, so other $200,000 is mine. Yeah, that's your equity, meaning that you claim on the asset, which is your house. But the same concept. Okay? So, if we decide equity means common stock, and by the way, it means common stock, not preferred stock is not part of it. Why not? Although it should be. Because the preferred stocks are not issued for the sake of raising capital. Common stocks are. We're going to talk about those. Therefore, they are not source of your capital. And the owners of your preferred stocks normally are your what? Internal people. You don't go and publicly trade preferred stocks. That doesn't happen that way. So because of that, when we talk about equity or claim, we're talking about the claim of the stockholders that you have what? Common stocks. They don't have preferred stocks. They normally have common stock. When you go to stock market, you buy the stock of any company, you're buying common stock. You're not buying preferred stock, because preferred stock, those companies are not for sale. Okay. Now, because of that, we're going to say that stocks are important. Why stocks are important? Because they played a major role in financial market. The health of financial health of all the companies depend on performance of their stocks. If their stock value declines, not only they're losing all the investors, but also they're losing what the value of their stocks, therefore what value of their company. If you, let's say, 80% of your source of capital comes from stocks, then those stocks are not performing well, losing value. Basically, your company is losing value. The company that might worth 500 million, all of a sudden becomes 5 million, meaning that you're devastated, you're done. So that is why we put a lot of emphasis on stock and stock valuation. I'm going to talk about this when we get to the discussion of stocks. And we're going to do some exercise on it in the class to value or come up with the analysis of stock valuation. But for now, the intention about this stock is this. I would like to share this with you. Can anyone tell me how the publicly traded stock's value is determined? Meaning, why in the world value of certain stocks of certain company gains value, perform well, some companies not so. What is the reason, or what are the reasons, perhaps? And by the way, I'm asking these questions, not necessarily expecting the answer, but I want to stimulate your mind. Have you thinking about it?
How the company is doing, how the company
How is the company doing? Right. So, does public know how the company is doing? Does everybody know who in the market or buying and selling the stocks of this company?
No.
They know they don't, huh?
But there will be mediators.
They would be what?
Mediators, right?
Mediator,
Like
okay.
the general people say this company is doing well, you can invest in this.
So everybody invests and buys and sells stuff through the mediators?
No, not all, but few of them.
Yeah. So public buys and sells stock based on what? Speculation, folks. Asymmetric information, speculation, and expectations. That's what it is. Guessing game for these people. So, in private or publicly traded stock in the market, the market value of stocks is determined by what? Speculation. And what the speculation determines, basically, supply and demand. That's what it is. When the demand for a stock goes up, guess what? Value of it goes up. Well, your question is, why demand for this stock is going up? Because somebody said, yeah, well, you know what? They have a new technology. They're going to be developing in the future. They're going to be doing Really? Well, no. Makes sense? That's why people buy and sell stocks based on speculation. Guess what? Many people that I talked to in life regarding this stock, and I asked them, how do you buy and sell the stocks? You know what the answer is? My cousin called me the other day. He said that this stock is going to be going like crazy. Why? Because their company is going to IPO within a week. Oh my God. Guess what? After a year or so, they're already, they lost their shirts and they are regretting for what they did. Most stock. That's how people buy and sell stock, believe it or not. That's market value of the stock based on supply and demand. Simple as that. Now, why supply, when you recapitalize, means that you take your stocks out of the market, value of it increases because supply of it is less. When the demand for the stock increases, meaning that people think that the stock is good, whether it is or not, the value of it is going to go up. Simple as that. And those are based on asymmetric information, based on just guessing game, folks, believe it or not. Why do you think that people are glued in financial environment? People are glued to TV when Federal Reserve wants to set the rate. Many of them even don't understand what Federal Reserve is all about. But they're glued, they want to know, oh, interest rate dropped, therefore I'm going to sell this, buy this. That's what they do. So, market value of stocks are determined by supply and demand, and supply and demand is determined by speculation, period. Therefore, our job here in this class is to learn something about stocks. What is that? Is there any other value for the stocks beside that, besides supply and demand, besides the speculation? Yes. That's what the stock analysts do. What is that? Come out with the true value of stock by calculation, by method, by statistics, by mathematics. Simple as that. So all the stock analysts in the market, they are not speculating. Oh yeah, listen, no. They're doing the calculation. That's why they are the mediator. They are the core of the financial world and circulation of all everything finance. They are the core. Why? Because they do their job. Let me give you an example. And I'm sure that you're familiar with this kind of people and this mindset of these people. The guy goes and buys the stocks of a company, and you ask him, why did you buy this stock? Well, first of all, it was performing very good historically. Okay, good, something. And also, I have very much believe that this stock is going to increase in value. Why do you think that? Oh, because they are in, let's say this is stock of a farm, corn farm. Because biofuel is going to be very, very important in the future. Well, those are the things. Those are the conversations. Now, if that individual buys the stock and is under the impression that it's going to beat the market, guess what? How wrong that individual is. First of all, I'm going to tell you flat out, nobody beats the market, period. And second of all, if you want to beat the market, you know what you need? You need to be stock analyst, stock specialist on the floor of stock market every damn day. Then you could, possibly. So who these people are? Oh, I'll tell you who these people are. First of all, some of these stock analysts, on top of each stock, in average, we have 100 stock analysts in average. Who are these people? Well, first of all, they are highly educated people from good universities. Most of them are from Ivy League universities with a degree in medicine, degrees in physics, degrees in, rocket scientists and all these stuff. Very well educated and smart people. Why they are in the stock market? Because they love money. Not only that, they have all the tools. What are the tools? Well, Jesus Christ, we have 420 just formulas in finance for calculating different things, let alone other means that are through the internet, through their connection with the rest of the world, the information that they get in every day, and how you analyze all those. They know them all. But not only that, on top of that, they dedicate every minute of their lives to get involved in this for long hours. So tomorrow I come along and my cousin tells me, yeah, this stock is going to perform well, and I want to beat him. Are you kidding me? I'm going to beat those people? Get real, folks. They cannot even beat the market themselves, let alone you, just because your cousin was drunk and told you something. So my point is that, going back to, of course I'm making this melodramatic to give you the importance of it, that stock market operates based on speculation. If you want to get involved in the buying and selling of the stock based on the market values, I would suggest that you take your money to Las Vegas, you have better chance. Simple as that. So, if that's the case, then can we buy and sell the stocks with confidence that we determine the true value of it is not market value? The answer is yes. That's called real or intrinsic value of stock, and it's determined by certain calculation. Are we going to learn those in this class? Yes, we are. So I'm going to show you. Those are, by the way, not that we're going to walk around here, the specialist stock, specialist and analyst, but no, you're going to know what it is, and you're going to be able to do some of those yourself. In order to be as an expert, you need to spend more time, years, to really gain the knowledge, more knowledge. But we're going to know what it is. You're going to be able to do very simple math, simple calculation, and come up with the true value of the stock versus what? The market value. Now, some of you may ask me, Dan, what is the benefit of that? No, okay, I got the true value of this stock, and the market says this value, so big deal. Well, no, it is a big deal. I'll tell you why. If you do the analysis on the stock and come up with the true value of it, intrinsic value of it, and it says $30 per share, then you're going to take a look at the market value of it. How much market is set in this? Oh, $40. So what are you going to do? What are you going to do? Buy it or sell it? You're going to market is saying $30. The true value of this $20. Get rid of them. Meaning that you're going to get $10 per share. That is not actually the value of this share, but market says it is. Okay, thank you. How many you got? 10,000. Get it out right now. Sell them all. Because you're going to get what? $10 for each. On the other hand, if you come out with the $30 of value of your stock, and market is selling it for what? $20, buy as many as you possibly can. Because the true value of this $30, market doesn't understand it. Market is trading it for $20. Buy it as much as much. That's how you buy and sell, folks. Does the market unreasonably could bring the value of the stock so low? Yes, they did. Or unreasonably bring your value of the stock so high that it's not even realistic? Yes, they do. Give you an example. A long time ago, a stock market was in trouble. Basically, it was almost crashing. And all the stocks were losing the value. General Electric's stocks also were among them, obviously, just nosediving. It got to the point being devalued so much that Jack Walsh, I think it was the CEO of General Electric at that time, he went straight to floor of the New York Stock Exchange and said that, stop, I'm buying all my own stock back. Because you know what, you idiot, you don't deserve to have my stocks. My stocks is $85 per share, the intrinsic value of it. You're exchanging it for $25 and still going down? You don't deserve it. I'm going to buy them all. He bought all the stocks of GE. They said, you don't deserve it. But guess what? That prompted the price of stock to go up again. I don't know how much it did, but that's what I mean. Market normally is unreasonable, just because of supply and demand. Well, somebody convinced me that cryptocurrency, Bitcoin, is a good investment. Please do. Yeah, good investment, but it's like pyramid scheme, right? As long as you are, making money, you're good. But guess what, folks? As much as it may provide you as capital gain or increase in the value, could devastate you as well, because there's nothing behind it. I come here and say, folks, I have this piece of paper. Who wants to buy it? And this paper may be a special paper. Who wants to buy it? I buy it. All of them, 500,000 people buying it. Guess what? This piece of paper that does not even have price of half a penny may increase to be 100,000 per sheet, just because people want it. Think about the reality of life. Folks, there was a time that I remember here in the United States, people were buying, jumping rocks, Cheopet. Think about it. Well, Cabbage Patch dolls, anybody remember that? Ugly piece of whatever. People they will run out of their all product. People begging that we give you hundreds of dollars for that. What is it? Nothing. Because of supply and demand. So my point is that many of the investments are made in that way. But you have to be aware of it. You have to be cognizant of that. What is the backing of this particular financial asset? Is there anything behind it? This is exactly what happened in financial crises. We had MBSs, mortgage-backed securities. What is MBS? Basically, in a brief version of it, is when you borrow money from bank, folks, let's say you borrow money from Bank of America, $500,000 to buy a house. Okay. When bank gives you that $500,000, what do you got? What do you got? You got $500,000, right? What does bank do have? What bank has in exchange of $500,000 that gave it to you? What bank has? You have $500,000, what bank has?
The house.
Your house, exactly. They are the owner of your house. However, banks not only make money because of the interest that's collected every month on your mortgage payment, but also they make more money by securitizing your house. In other words, what I'm saying is they come Bank of America, I have loaned out billions of dollars and I'm owner of 50,000 houses, 100,000 houses. Legally I own it, 100,000 of houses right there. You know what they do? Say, look, my God, hundreds of thousands of, or not hundreds, hundreds of millions or billions of dollars worth of houses that I own. They're sitting idle there. Can I make money over this asset, real asset? Yes, you can. What can I do with it? Well, you could securitize them. What is that? It means that you could issue bonds that are backed up with all these houses. You follow? And sell the bonds and get money. That's what they do. That's called mortgage-backed security. Now, why I'm sharing this with you? Because in banking system, securitization is perhaps the most profitable aspect of their revenues. But most importantly, why I said this is that I said in financial crises, this is what happened. Meaning that they issued bonds with houses behind it. But what type of houses they were? All the houses that were subprime loans and all the houses that we know they went to foreclosures. Worse than having nothing. Like I said, bonds may have nothing behind their strong part, we know that. But mortgage-backed securities, even if had those houses, there were houses with liability rather than asset. That's why they went down. But why people bought it? Why investment companies bought it? Why pension fund companies bought it? Why Merrill Lynch bought it? Why Goldman Sachs bought it? Why Lehman Brothers bought it? Because they were rated all AAA. Oh, did they lie to us? You bet you. That's what they did. Because if the Bank of America issued these MBSs and issued in terms of hundreds of billions of dollars, and there are companies who are willing to buy this, the Bank of America cannot come out and say, oh, by the way, folks, these are all based on subprime loans and they're going to be defaulted. Nobody's going to buy this bond. So they have to lie it. Now, how they lie it, they tell the rating agencies like Moody's, Standard & Poor's, and Fitch that, hey, we're your best customers, so don't make us to get out of market. Don't make us to file a bankruptcy, because we could. Rate them accordingly, not accordingly, rate them based on what you know what's happening. And they basically rated all the junk bonds as AAA. And everybody trusts those institutions. And they start buying those. And the rest is history. I'm going to talk about this later in more detail.
I just wanted to offer, there was a podcast exactly about that by Michael Lewis, the guy that wrote The Big Short. It's called Against the Rules.
Mm-hmm.
And one episode is entirely about Moody's.
Now, here we go.
Fitch, and
Yeah. Standard & Poor's.
yeah, and how they were muscled into giving AAA ratings to a bunch of junk.
Absolutely. Absolutely. And there's another movie on it, you said?
No, it's a podcast.
Okay, but
It's called
podcast.
Against the Rules.
Gotcha. Yeah, I mean, you could imagine, if I'm the Bank of America and I have hundreds of billions of MBSs out there, and let's say you're the Moody's CEO, I'm going to call you. Hey, how are you? I'm good. How are the kids? Fine. You know what's happening though? Yeah, I know. Well, you know what to do. Yeah, no problem. Don't worry. I'll see you in golf course. That's what happened. Guess what? They were all fined by the Department of Justice. Not only the banks, financial investment banks also, commercial banks, investment banks, and also Moody and Fitch and all those people were fined big money, like in terms of billions, all of them. And I'm going to give you even a statistic of how much each bank paid Department of Justice and how much Moody paid. So, meaning that it's not our perception or our interpretation, it's real.
Yeah.
Yeah. Okay, where are we in this stock? Yeah. So, this stock has two values, market price and intrinsic price. Intrinsic value of it is the true value of it. That is what? Is calculated by through two things. The true investment or investor's cash flow. What does that mean? The calculation of what type of cash flow this stock is going to be generated in the future. And you're going to be going to do a lot of exercise on it in this class, how we do that. And also what kind of risk associated with that. Because without that, this doesn't mean much. Why? Because you may calculate this and say, oh my God, look, rate of return of this stock is 24% and the average of the market is 12%. Wonderful, yeah. Did you do this also? The risk of this stock is 4 times as the other stocks. High risk, high return. We're going to learn that. So now, after you did that, is it something acceptable? Yeah, okay, then go to take a chance. But if you don't do that, don't let the higher rate of return to fool you. The biggest high rate of return of many investment, especially financial instruments, like junk bond, is unparalleled to other investments. Oh, you're way up there. Yield you like 38%, 42% a year. What kind of investment gives you that? None. But guess what? They also are 4 times as much as the average of the market. They have the risk. They could go bankrupt any day. So, how we calculate the true risk, how we calculate the true cash flows? By managerial action, economic environment, taxes, and political climates. They're all impacted. But guess what? What is not shown here is what we're going to learn in this class. Meaning that how you come up with these two based on what? Calculations, models, methods. And there are 4 methods, for instance, to come up with the intrinsic value of stock. And we're going to learn all 4 models. That's how we do it. And then this is how stock and analysts do it, basically, to come up with the intrinsic value of the stock versus the market value. And that's how they buy and sell the stocks. On the other hand, the market price of stock consists of perceived investor cash flow and perceived risk. What is perceived is most of guessing, speculation. There is no analysis behind it. There is no analytics behind it. Like 90% of the population. That's how they buy and sell stocks. And finally, if the intrinsic value of the stock is equal to market value of the stock, then we say the market is in what? Equilibrium. I mean, the market is operating 100% efficiently. Any questions? I guess you deserve your 15 minutes. Let's take a break for 15. So it is what?